Welcome, listeners. My name is Jim Kantowski. I'm joined here with my colleague, Jake Sadler. And today, on episode 16 of the show, we are going to be talking about taxes. You ready for this one, Jake?
I'm ready. It's the most wonderful time of the year, right? It's middle of November, and taxes are all we're thinking about in a lot of ways. So, yeah, here we are.
It is amazing how quickly this comes around, this tax season every year.
Oh, yeah.
You push through till April 15th. At least those of us who prepare taxes, you push through to April 15th. You get some extensions. You pick it up again, in the middle of the year. And then you got your final extensions for businesses and personal income tax returns in September and October. And then you're deep into planning before the year end.
We should have figured out before we recorded today, how many different deadlines do we have each year for taxes?
Yeah, that's a good one. We'll have to get back to that because, there's all kinds of different returns and different dates that are due and extensions. Extensions are different. So there's a lot of different things going on. I think
Google doesn't even have an answer. It's too many. Too many
for the answer, but you did have some facts you were telling me about tax season. You want to share some of those facts?
Sure. Yeah. No, we got some good facts for you, just to, make tax season a little bit more exciting. Well, I shared the facts with you beforehand, so I think making it a pop quiz wouldn't be as fun. But, I think one of the things that gets a lot of attention is how complex the tax code is, the Internal Revenue Code. And just to put it in perspective, in terms of the total number of pages, the U.S. tax code is just under 7,000 pages. And then when you add together all the regulations and tax guidance from the IRS, that number goes up tenfold to over 75,000 pages. So that's kind of what we have to contend with around tax planning is a whole lot of rules.
Yeah, there are definitely a lot of rules, and it's hard to know everything. And so a lot of tax people do specialize in different areas, which is good. We tend to stay on the individual and small business side of things, and it's complicated. But it's something we can handle. What else do you have in there?
Well, I mean, on top of the fact that we've got 75,000 pages worth of regulations and the tax code itself. It's constantly changing. If there's anything that's constant, it's change when it comes to taxes. But it's ironic because so many of the, pieces of tax legislation that have been rolled out are called or have been called at some point in time permanent. And but since 2000, there have been over 35 different major tax acts passed through the U.S. Congress. So that's about 1.5 per year. On if you kind of average it out. So change is 35 major pieces of tax legislation since 2000. And it's only 2022. So, I mean, obviously the math's pretty clear. There's more than one a year.
Yeah. And I'm very grateful that in 2022, so far this year, we have not had any major tax legislation passed. We went through a whirlwind from 2018. We had a major tax overhaul. And then, when COVID hit, we had some major tax issues, major tax changes that we had to contend with, which were not easy. So it's nice to have a little bit of a break.
It is nice to have a little bit of a break, and especially here at the end of the year, because so often, these major pieces of tax legislation get passed at the last minute. Sometimes they end up retroactively impacting the decisions that you made during the tax year. And I'm curious from your perspective, Jim, I mean, we're constantly attuned to, what's hanging out there as, legislation that's either, in the process or being proposed, kind of to what extent, are you factoring in, what's out there as proposed legislation? How does that potentially impact the decisions that we're helping clients navigate through in the present moment?
Yeah, that's a really good question. And one, quite frankly, I struggle with. I like to deal in facts and what's out there and what's available. And, when you have something that's proposed, in the media, or, it may or may not come to fruition. And so, you're thinking about these things and you want to understand who might be affected or who might benefit from these tax law changes. But it's really hard to implement something without it actually being passed. I last year they were talking about changing capital gains rates and limiting Roth conversions and these different things, and they never happen. And some people actually recognized capital gains and sold investments based on something that may or may not happen, and it causes problems, and it's a lot of activity around that, and it gets a lot of press, and so it's something very challenging to navigate, no doubt about it.
It really is, and like talking about it now, I mean, it in so many ways, it's part of one of our central themes in the work that we do. It's managing uncertainty in so many ways, whether we're talking about the investment portfolio or future employment and objectives towards your, financial independence, whatever it is, there's uncertainty out there. There's uncertainty when it comes to the tax situation that anyone's in any given year, and the legislation that's proposed, that's out there today, that could impact decisions that you have on the table in front of you. And I'm with you. I mean, I like dealing in facts. Here's what we know. And, if there is something that is, there's a higher than not degree of likelihood that it could impact the decisions you're making today, then you make that assessment. Okay, what kind of time do we have to wait to make this decision? And it's a tough balancing act to strike.
Yeah, it's definitely a tough balancing act. I mean, you talk about the uncertainty around it, but the other thing we do talk about is controlling what we can control, because we deal in the investment markets, which are completely out of our control. I mean, we do have some control over taxes. We can make some decisions to try and minimize taxes by implementing different strategies, and that is something we can control when the markets are volatile and acting up. It does give us a sense of something we can implement. It's not a great word for it, but something we can control and take action on to try and save some money or reduce our costs.
100%. Yeah, I completely agree with that. I mean, if we're looking at, just what markets have done, this year, there hasn't been a whole lot of, great news out there. So, ultimately we can't control what's happening in markets, but we can work with the set of facts that we have today as it relates to income taxes and the decisions that can be made for tax benefit in the current year that affect the investment portfolio. So yeah, focusing on what we can control a lot of times, that does boil down to the tax picture.
Yeah, and we're going to get into some of those things, some of those tips. We have a few tips we can share, about things you can do for the year end here. But, one of the things I was thinking about is, what was that?
Oh, before we dive in, I do want to give you a pop quiz. So because so Jim had the benefit of seeing some of these facts beforehand. Jim, what year were you born?
1971.
Okay, what was the top marginal rate in 1971?
I have no idea. I know, like, when I was a youngster, like, inflation was really high, and my dad used to complain about gas prices, and I remember waiting in some lines, and that sort of thing. But I don't remember the marginal tax rates.
Okay, all right. Well, yeah, you're a newborn, and the marginal tax rate. So 70% was the highest marginal rate in 1971. It's 37% today. So just a little, interesting fact. Taxes can change, in some ways for the better. If you don't like paying taxes, and in 1971, you would have had a higher rate than you do today if you were at the highest, marginal bracket.
Yeah, highest marginal bracket. And just for a little clarity, the marginal bracket is the top tax you pay on income over a certain level. It's not just your whole income isn't being taxed at 74%. So just to provide a little clarity around that.
That's maybe one other interesting point. So when we look back at marginal rates, of the past, in 1944 and 1945, the highest marginal rate was 94%. That's for income over 200,000 at that point in time, so about $3.5 million in today's dollars. But one of the interesting things, this is my only point around this, that's an extreme, tax rate, right? So for income over that 200,000 in 1944, 45, you'd be getting hit at 94%. One of the things you see, kind of looking into that is that at that point in time, not a lot of people were actually getting hit with that 94% top margin rate because they were doing a lot of creative and effective tax planning to, lower their income, get their margin rate down, and get their overall effective rate down. So I think when we look back at these margin rates in the past, they've been a lot higher than they are today. But I think at every point in time, there have been really interesting and effective, tax planning opportunities to help control, the taxes that you're paying.
Yeah, and to close to all those tax law changes you've talked about, in a lot of instances, is to close up some of those loopholes and those planning opportunities. So
Right.
they've gotten smaller in a way. So we don't have a lot of exciting material here for you today, but we are going to share a few things that you can implement before the year end.
I wanted to avoid the word loophole, but yeah, I think there have been loopholes in the past, and a lot of them have been closed for sure.
Yeah. So you want to kick this thing off? You want to go one by one and just share some of these tips that we have? We'll just talk through.
Yeah, no, let's dive in. I mean, we're kind of started off, 'tis the season for tax planning, and there's a difference between tax planning and tax preparation. Planning is done in advance, and a lot of planning opportunities are going to only exist within the calendar year. So this is kind of that point in the year where we want to be really mindful of what can we do, what do we need to be looking at before the very end of the year to create some tax advantages. And I think we'll just kind of start right off the bat with, definitely calendar year specific, topic, which is deductions. On the personal income tax side, taxpayers, in recent years, a lot more tax filers have been taking the standard deduction. So that's the deduction that everybody gets. You don't have to add up your deductions to get it. You just get it. And Jim, do you have that number top of mind for the current stock?
25,900.
25,900. So, to get up and over, if you do have enough qualified expenses that count as a, income tax deduction, and you have more of those in total than the standard deduction, then you can kind of create a more favorable tax picture for yourself. So you can deduct more of your income. But it's kind of hard, depending on, your circumstances, to have more deductions than the standard deduction because it's grown over the years. And there are now important limitations on what once were really valuable deductions like state and local taxes that you're paying. So now you're capped at $10,000 per year. So, one strategy for folks, if kind of year over year, you're adding up your itemized expenses, you're limited to that $10,000 per year on state and local, but you're kind of close. You're doing some charitable, maybe you have medical expenses from year to year, and you're kind of getting close to that standard deduction. One strategy is to, lump as many of your itemized deductions into one calendar year, then take the standard the following year. Then in the year after that, lump as many of your itemized expenses together as you can to itemize. So you're kind of in this kind of 2-year rolling cycle. You're itemizing one year, taking the standard the next, itemizing the next year. And so there are opportunities to kind of lump some itemized expenses into the current calendar year. And I'll throw it back to you, Jim, to run through a couple of examples for that.
Yeah. So, just like your mortgage interest has changed over the years. That used to be a really, really big deduction. Interest rates were higher. As interest rates come down, people aren't paying as much interest. So it hasn't had a great effect. But, if your mortgage payment is due on December 31st, you might want to, you have this leeway where you can pay it on January 1 or January 5th or something like that. You definitely want to make sure that it gets into the mortgage company's hands, prior to the end of the year so that you can get that extra interest added to your itemized deduction is one thing. Like you mentioned, the itemized deductions for state and local income tax is $10,000 now. But, if your real estate taxes are $2,000 and, you've paid in $5,000 for state income taxes, and you think you're going to owe some more at the end of the year, you want to write that check for state income taxes prior to the end of the year and have it sent into your your state taxing agency. In addition, I think the other one that we talked on our last episode about charitable giving is bunching charitable gifts. That's a big one. A lot of people were missing out on some of those deductions since the standard deduction went up. And so, making those in 1 year and skipping the next is a great way to do that. That's called bunching.
Bunching your itemized deduction. I think definitely that's a good segue into, conversation around charitable. Yeah, we were just talking about this, last week in our most recent episode. But because, again, the standard deduction's a lot higher now, depending on if you have charitable intent, depending on how much you're doing each year, you may not be doing enough to get over that, to have enough in charitable deductions to get your itemized up and over the standard. So bunching them into 1 year to get up and over the standard, that can be a great strategy. But for some folks, they may not want to give that much to the organizations that are important to them in 1 year. And I think back into the conversation, comes the donor advised fund, where you can capture a tax benefit. Essentially, you can look at it like pre-funding your charitable contributions to the causes and organizations that are important to you in a single tax year. So you kind of lump sum fund the next 5 years, 10 years, whatever it is, into a donor advised fund. You take the deduction for that lump sum contribution in that year, and then you can make your grants from your donor advised fund at the frequency that you want. So if it was 100,000 over 10 years, you're doing 10,000 a year. You don't have to give 100,000 to your organizations in 1 year. Put 100,000 to a donor advised fund, and then dole it out in those $10,000 increments that you always wanted to, year over year.
Yeah, I think that's a whole other episode. I think we're going to get somebody on here from one of those donor advised funds and have them run through the details of that. I think that would be some great information for people to do. That's been a big one for sure. So these are gifts to charities. This next one I have, but you can give money to family members or just gifts to other individuals, and it's not a tax deduction on your income tax return. But you are allowed to give individuals $16,000 a year without affecting your estate tax exclusion. So just remember that you can give $16,000 to anybody you like, and then your spouse could give $16,000. So you can essentially get out of your estate $32,000 a year per individual that you want to provide some money to in the future.
Yeah, that's a really important strategy for folks that, say just, family gifts each year are important. That annual gift exclusion is, that's on a calendar year basis. So, you kind of want to take advantage of that each year if that's a part of what you're doing. And it also counts towards if, say you're, for example, just a grandparent maybe funding 529 plan contributions for a grandchild. That $16,000 limit, on annual gifts also applies to those 529 plan contributions. So in the limit that you have each year. So
529s is our next one. That is only a state income tax deduction. You're in North Carolina. Does North Carolina provide a state income tax deduction for the 529s?
No, we do not.
You do not. Okay, that's fine. The big benefit is the tax-free growth on those. Maryland provides.
She was saying we, it wasn't my choice.
Yeah. Maryland provides a $2,500 deduction per account per beneficiary, so you and your spouse can but put into a funded 529 plan for one of your kids and get a $5,000 Maryland income tax deduction, which isn't that big of a deal. It's 7.5% essentially that you get a deduction for. But again, that money goes into that account and grows tax-free so that when you take it out to actually pay for education, you're not paying any income taxes, on that money if it's for a qualified education expense. And so one thing I'd like to point out as part of this tax conversation is, when we think about taxes, a lot of these decisions you make may not give you this great upfront tax deduction, but they can benefit you in 10, 15, 20 years significantly if you make the good tax smart decisions now.
Yeah, that's a really good point because, I think it's easy to think about tax planning in each year as really just a decision to reduce the tax liability in the current year. But so many of the planning opportunities have a longer term perspective and can create a tax benefit for you over longer periods of time. I think maybe that's a natural segue into one of those decisions, which is the Roth conversion decision. So taking dollars that you have in a traditional pre-tax IRA and converting them into a Roth IRA. So when you do that, the amount that you convert is taxable income in the year that you convert it. So that decision is actually one to increase your tax liability in the current year. But so much of the logic and reasoning for doing the conversion is that once it's in the Roth, it's tax-free, essentially forever thereafter. It could be for you in your lifetime for qualified distributions. It could be for your heirs and beneficiaries to the Roth. So there's this longer-term tax advantage that you can create for yourself and an enhancement, a potential enhancement in value over time, but it is not immediate.
No, it's not. And one thing I want to point out on those Roth conversions is the real opportunity is in when you're in a low income tax year currently. So you have to really think about these and say to yourself, hey, what's my current income tax now? And what might it be in the future? And see if there's a difference. And you want to make sure that you're thinking about your tax rate as lower now and higher in the future. You would not want to necessarily convert an IRA to a Roth IRA if you feel like you're in a high tax income bracket and you'll be in a lower one in the future. So what I like to think about is if you're working, you're in your high earning years, not a great opportunity to convert to Roth IRAs. But if you've retired, and let's just say you haven't started taking Social Security yet, you're 63 years old, essentially, you can have a 0% income tax. You have a $25,000 standard deduction, and then over and above that, you can get up to, if you keep your income under $84,000, you're in the 12% tax bracket. So those opportunities are really, really good to convert to Roth IRAs. I love that strategy.
Yeah, it's a really great strategy, and it's the conversations around Roth conversions. That can at first blush, if this is kind of a new concept, it can kind of leave you scratching your head and what on earth? Why would I create more taxable income for myself this year? I thought I wanted to reduce taxable income as much as possible. When you run the numbers, and especially in those situations, like you pointed out, if you're in a lower tax bracket today than you are thinking you're going to be in the future, that's still a guess, but you can make a pretty good guess around that. So if you're lower tax rate than you're going to be in the future, that Roth conversion, the numbers, with reasonable assumptions, are going to look pretty good.
So we're going to stick to IRAs, and right now and tie it back to the charitable contributions. One of the things you can do is that QCD, qualified charitable distribution from your IRA, and at age 70 and a half, once you're over age 70 and a half, you can give $100,000 out of your retirement account directly to a charity. And what that does is it doesn't put it in your income, and therefore it's not taxable. And so you can, how do I explain this? You don't have to take the charitable deduction on the itemized deduction Schedule A. And so you can sort of get the standard deduction of $25,000 plus your charitable deduction can be tax free.
Yeah, the QCDs for a lot of folks in retirement can really be the most tax efficient strategy to give charitably. And so that 70 and a half date that you mentioned, Jim, it's a really odd number, right? I mean, 70 and a half, you can't do qualified charitable distributions if you're 70 and 3 months. But on your 70 and a half birthday, you can start doing these qualified charitable distributions. I think where it really, really kind of comes into its own as an effective strategy is once you reach age, right now under current law, 72, and you have those required minimum distributions that need to come out of you've got to take money out, the minimum amount it's required to come out. IRS sets, the table to calculate that. And it can be up a substantial number and dramatically change your income tax picture, put you into a higher bracket once your RMDs start. So for some folks that maybe they don't need all of their RMD for their living expenses, the money's got to come out as taxable income. So you can use these qualified charitable distributions to count towards your required minimum distribution. So if you have a $20,000 RMD, once your RMDs start, you could do $20,000 in qualified charitable distributions. The money came out, you satisfied the IRS rules on taking the money out, but since it went straight to a charitable organization, that's not counting as taxable income for you.
Yeah, it's a great strategy. So bouncing back a little bit, something we've been doing a lot of this year because of the markets have declined for the majority of the year. We've had a little bounce back here in October and November. But let's talk about some of the things we've been doing proactively in terms of investments to manage taxes.
Yeah, no, definitely. So I think one of those key strategies, if you have taxable assets, so assets in taxable accounts, brokerage accounts, sometimes called, you may have the opportunity to do what's called tax loss harvesting. So as the investments, are in your taxable account, if they go up in value, well, then you start accruing these, unrealized gains. And so when you go to sell an investment that's gone up in value, you realize the gain since the time that you bought it. That's taxable at capital gains tax rates. Conversely, if you buy an investment and it goes down in value, you can sell that investment and realize a capital loss. And that capital loss can be used as a really valuable tool in tax planning to offset capital gains that you have dollar for dollar. And if you don't have as much in capital gains as you do in capital losses, you can use up to $3,000 per year of those losses to offset ordinary income. And if you don't use up all the losses that you booked, you can carry them forward indefinitely. But I will point out kind of two caveats to this strategy. One, it really works best when you are implementing an investment strategy where you can sell an investment that's gone down in value and immediately buy back an equivalent, but not identical investment. So you can't buy the same investment that you just sold the same day you sold it. That triggers what's called the wash sale rule and disqualifies the loss for tax planning purposes. So if you have the ability to sell an investment that's down and buy back an equivalent, but not identical, that allows you to maintain the structure of your investment portfolio.
Yeah, and so you just have to wait 31 days before you buy that back. And so, I mean, there's some risk there, and that means like if you sell it at a loss, you're waiting 31 days, and there's a big rebound during that time frame. You could miss out on some of that. So it's nice to be able to buy it back immediately. One thing that people don't talk about too much in terms of these recognizing losses is actually recognizing gains. There's some opportunities to recognize some gains in some situations. And again, if you happen to be in a tax bracket or if you happen to have lower income amount in a certain year or a big deduction or something of that nature, you can actually pay 0% on capital gains, or the tax rate on capital gains is 0% up to the 12% tax bracket. Which is for a married filing joint, is which we refer to most, is somewhere around $84,000. So if you have no other income and you have a standard deduction of $25,000, you can essentially liquidate gains of $100,000 and pay 0% federal income tax on that. So that's a great one too that we look at on a regular basis, is actually recognizing gains when it's appropriate.
Yeah. 0% capital gains bracket is a really powerful tool. It may not be around forever. So if you have opportunity to take advantage of that, it is really essential to be planning in advance. And this is the time of year where we're, for the most part, making the decisions. Okay, you've got room in the 0% bracket. Let's harvest some gains. I think it's interesting wrinkle that has been coming up some this year. If some losses have been harvested for the year, but there's still room in the 0% bracket. So we want to harvest gains at the 0% bracket, but losses are going to have to go against the gains that we harvest. So we want our losses to be as valuable as possible. So we don't want our losses to offset gains that are taxed at 0%. We lost some value there.
Yeah.
So ideally, we want to push the gains that we're harvesting into the 15% bracket, which is the next one up for capital gains, at least to the amount of the losses that were booked, so that the losses go against the gains that are taxed at 15% and essentially bring all the capital gains for the year back down to zero.
That's a really, really good point. Thanks for bringing that up. There's some other opportunities. We're running out of time here, but there's some reasons to reposition your assets also. We've talked about, which we're doing internally, is some mutual funds pay out these capital gains, and there's opportunity you could have a loss. Let me just say, you could have a loss on your investment that you purchased and still have taxable income because that investment is actually paying out or distributing capital gains, it's called. So you want to make sure that you look at your portfolio and you decide, hey, I want to get rid of this before I get hit with a big capital gain, reinvest it in something maybe more tax efficient. Those are good planning opportunities there.
And I think just a couple more. I know we're kind of running short on time, but this is, as far as planning goes, this is absolutely not static. You don't have to just set the time on the calendar to do, okay, it's November, it's December, we're doing our tax planning, and then we're forgetting about it. We're only focused on what we're doing in November, December. I think this is just a great opportunity. We have the end of the year things that we want to look at, but it's also a great opportunity to look out at the year ahead and say, okay, what's the tax picture going to look like for you in the year ahead? What can we go ahead and start thinking about? And one of those that comes to mind, you kind of mentioned higher earners and kind of looking for, the ability to contribute pre-tax into retirement accounts. This is a great opportunity to say, okay, what does your cash flow look like for the year ahead? What does your savings capacity look like? Can you max out your 401k? Because a lot of times, and depending on the rules of your plan, you get to the end of the year, you don't really have the payroll coming in to be able to max out your 401k at the end of the year. You kind of need to get that started earlier in the year. So it's a good opportunity to think about what lies ahead for you in the following year, and to kind of go ahead and get in, the back of your mind, okay, what do I need to do before the April deadline? Maybe I can make some Roth IRA contributions. I have until April 15th of the following year to do that. Maybe I want to make a health savings account contribution. I have until April of the following year to do that, get a current year deduction. So I think just timing wise, this is a great opportunity to think about the year, the current year, and the year ahead.
Yeah, so we have 401k contributions, which typically there aren't income limits. There's the amounts you can put in there. And then we have IRA and Roth IRA contributions, which if you're part of a plan, they get limited significantly. So you definitely want to look at your 401k first if you're contributing, and then look at your opportunities for IRAs and Roth IRAs. There's also something called the backdoor Roth IRA. I know you don't like to call it the backdoor Roth IRA. But there is something out there where you can do a non-deductible IRA contribution and then convert it to a Roth. So like you said, there's a lot of reasons to be looking at your tax situation throughout the year for planning opportunities to make sure you're taking advantage of them, number one, and to make sure you're prepared from a cash flow perspective to take advantage of them. Because that can be the hardest part of doing all this, is having the cash to fund some of these accounts. And so just making sure that you're budgeting and planning for them is a really good way to look at it.
I think because I heard the sirens in the background, maybe that was on your side, Jim. I don't know what's going on outside. Maybe one of the new 87,000 IRS agents storming the doors because we're talking about tax planning. I did just want to maybe mention, and from your perspective, having prepared taxes for so many years, if you're someone that's thinking about engaging with a tax preparer for calendar year 2022, when's a good time to go ahead and reach out to a tax preparer to find out if they have capacity to take you on for this upcoming tax season?
Yeah, that's a really good question, Jake. Taxes are tough. And the one thing I will say is that the more engaged you are with your tax person, the more value you're going to get out of it. Tax preparers historically have looked backwards. They're trying to put information on a piece of paper about what happened, in the previous year. So reaching out to your preparer early on in the year and letting them know about situations that are going on within your life It's really important to do that up front. When you're preparing your tax return, when it's that time, get your information as early as possible to your tax preparer. I know that things get so crazy. April 1 through April 15th, you're doing what you can to just get returns out the door in a lot of situations, and there's not a whole lot of time to think and prepare and offer advice. So you definitely want to start early in the tax filing season, but also in the tax year. That's a really great observation. And be proactive, ask questions, and make sure you're taking advantage of the opportunities that you have. Bring them up to your CPA and just say, hey, I heard about this or I heard about that, and just get their perspective on it. I think it's a great idea. Well, Jake, we talked about taxes for about 35 minutes, which hopefully we kept some people engaged and they listened.
Time flew by.
Yeah, for us, it's great. We love talking about this stuff. So if you happen to stay on this long and you'd like to hear more about other topics, leave us a comment or subscribe. That would be fantastic. We'd love to get some more listeners and see if we're providing the information that is useful to you guys. So with that, Jake, this will be published after the Thanksgiving holiday. So I wish you and your family a happy Thanksgiving and holiday season.
Yep. Same to you and happy tax planning season.
All right, Jake, have a great day. See ya.
Thanks, everybody.